Hey, Dustin Tibbetts, financial advisor here with Jazz Wealth Managers. How you doing today? Hope you're having a good day here so far. We're going to dive into something a little different here. See, at Jazz Wealth, not trying to make a sales pitch out of this, but we'll help with every account you have, whether we manage it here or not. And a lot of times customers say, I get no help from my 401k. I know I'm paying them something, but I get no help. I ask them for help. They tell me pick a target date fund. Is that really what's best for me? So I want to go over an exact example today of one that we did for a customer because, it's going to help them out a lot. And I want to show you how we're kind of working on some ideas to be able to actually show you the difference between what you have and what you're going into so that you can see, I know what I'm up for, right? I know if I'm going to be aggressive. I know it's going to be a little wild, but I know what to expect going forward here. So we're going to dive right into this. I'll try to keep this really short for you. Here we go. We have a customer here. We don't need to say names, I guess. I blocked out the name. So we'll just say he had a 401k and he says, Dustin, will you look at my 401k? I said, sure, send me a statement. Let me see what you currently have and let me see what your options are. And I will dig through and find the best alternatives for you. So this was his existing and current holdings. He had an index fund. He had a bond fund. I said, well, wait a minute. That's 20% there. I already know that's not, you wanted to be aggressive, right? Don't you? That's why you have a bond fund, 20% in there. He had some international fund here, 15%, was in real estate for 10%, and had some money in money market funds, which is just a real slow, really like a savings account in general. So we said, okay, you want to be aggressive. Let's look at the choices you have and try to find the most efficient way to be aggressive. If we look at his current mix, he was paying about 0.27. That's fair. That's actually really fair for a 401k. I have no problems with that. But you can see he was basically only 70% in stocks versus bonds. So just to confirm, you want to be aggressive, right? You're a young guy. You can afford to be aggressive. Your account here at Jazz Wealth, although it's just getting started and it's very small, that's aggressive. You're okay with this? Yep, I'm okay with this. I want to go. So we look at his annualized returns. He's sitting around 7%. That's actually not entirely accurate. It's probably just a touch higher than that. And so we look at it and say, okay, well, let's see what we can do here, right? We've got some stats to go on with what you have. I know how to geek out and see everything I need to see. Now let's dig in further and see if we can be more efficient. Well, after playing around for a while, we found that he should keep the index fund, but we want to see him in some small caps as well because that was one of his choices in there. He didn't have a lot of choices, by the way. One of his choices. And then we could work out an international fund to keep him in there. I like the international funds in general, just not so much right now. I get it. They're not doing so well. But we found a cheaper alternative for him. So we were able to go in there and lower his overall cost from 0.27 to 0.10. Still really fair either way. I mean, a 0.27, there's nothing wrong with that. 0.1 though, it's always good to be able to save a little bit of money. We also got him more into stocks. You can see he's basically all in on stocks, which is fair. He's a young guy. He's in his 30s, right? He can afford to do this sort of thing, which helps bump up his total annualized return. Now he's taking a little bit more risk. If you happen to see this over here, the max drawdown looking back 5 years was about 20%. I'm going to bet that if I dug in deeper, that was probably October, November, December. Now, if we go back, his max drawdown was only 13.2%. Well, that's fair. He had some bond funds in there, and he also had the money market. So he's got money that's really not doing a whole lot for him. So he's taking a little bit more risk. He understands that. He's okay with that because hey, we want to grow our money while we're young. So here is the way we mapped it out. I had to block out his name, but we take a look at the purple account, which is his 401k suggestion by me, and then we look at his current mix right there just to see the investment difference in returns. That's a substantial difference looking back over the last 10 years. Annualized returns are going to average him over 10 years, 10.2%. Very respectable. Not too bad there, but we can do better. And so now we're at 12.89% as a sort of forward expected returns, or at least in terms of how he's invested. Remember, we also lowered his expense ratio, so you could count that as basically 13%. So right there, anything he will ever pay me, ever in life, is more than made up for by just making a simple change to his 401k. Let's take it a step further. We want to look at the results. So we say, well, what happens if you don't go down this route? What happens if you say, no, Dustin, I don't want to be aggressive. I'll stick with what I have. Well, if we assume that his starting balance was $20,000, which it was, I believe it was close to that, and we assume that he only added $1,000 a year between his contributions and his employer's contribution. I just wanted to put something in there. I don't know exactly how much he contributes at the moment, but I wanted to put something in there because we know he's adding to it, and I wanted to keep it small just so you guys don't think I'm trying to really inflate the numbers or anything. So he's a young guy. Let's say 25 years from now, he's followed this. He's put in a total of $45,000. We'll assume that inflation is just roughly 3% in that camp there. And we're going to say that he never actually raises his contribution. So he's got the choice, stick with what he has or go with what we're suggesting here. And we're going to assume that he just follows this and never changes a single thing to make the math stupidly simple for me so that I could share something interesting with you. So let's dive in. His current 401k would result in $209,304 if he stays on the path that he is. That's respectable, right? There's really nothing wrong with that. That's actually pretty good. But for a guy that wanted to be aggressive, could we improve upon that? If we adjust his 401k and he goes with the mix that we suggested, he's looking at a double. Right? $435,760, assuming he follows this path for basically the rest of his working life. The difference of $226,456, all by simply making a change from multiple funds down to just these three. Now, these are not in any way a suggestion for you to go dig these up and pull these out. This is just an illustration to show when you invest in your 401k, go for what is best for you. Get somebody to help you. I'm happy to help you. This is naturally a marketing video. You guys know that. I'm happy to help you, but go find the most efficient way to handle your investments. See, at the end of the day, could you just pick a target date fund or something? Sure. But when we tried to do that, we found that we could actually do better by moving away from that. And sometimes the target date fund's the answer, sometimes it's not, right? I mean, you just got to see what's the most efficient way to go. So for a guy that wanted to be invested, we literally just made him $200,000+ more over the life of his investments because he's making the small little adjustment. Now, the big deal here was that I was able to actually send him the screenshots and say, take a look. This is where you're at. This is where you're going to go. Now, I'm not saying it's not going to be a smooth ride the whole way. It's going to be bumpy, but you said you're okay with that and you're ready to roll. So if you're ready to roll, this is what I want you to do. Now, here's the other part to it. Every year, February or so, if there's going to be additional funds added to your 401k, that's about the time they do it, January, February. He's now going to email me once a year, at least, right? I'll hear from him more often than that, but at least once a year, we're going to say, let's take what you have and compare it to any new offerings that you have. Can we adjust and do even better? If not, we'll stay with what we have. Maybe we'll rebalance and everything will be fine. But those little things make huge, huge dollars and differences over your lifespan. If you're in your 20s and you're in your 30s, most people don't look at their 401k. They just go, it's in there. I put some money away. I'm sure I'm doing the right thing. You're doing the right thing. I agree with you. But let's be as efficient with the right thing as possible because it could make a huge, huge, huge difference. Well, hey, anyways, we do another show today called The Closing Beat, and it is going to be at 5 o'clock Eastern Time live on our YouTube channel. You're welcome to come and join. We talk about the stock market, whatever happened throughout the day. We'll just go over that, keep all that sort of fluff out of it, and get right down to the nitty-gritty. I hope you enjoyed this, and if so, maybe you'll hit the thumbs up button, or even better yet, check us out at Jazz Wealth. I appreciate you watching. Have a great rest of your day.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.